In this video, I'm going to explain implied volatility for options trading, step by step, from the perspective of a professional options trader. So, if you're trying to understand how implied volatility relates to options trading, why it's important, and how it can help you become a better trader, then this is the video for you. Now, if you don't have time to watch the whole video and you'd rather get our cheat sheet explaining the most important things with implied volatility, you can click the button that should pop up on the corner of this video or go to the link I have in the description. My name's Scott Bauer. I've been trading for over 30 years. I'm a former Goldman Sachs VP, and today I'm going to teach you how the real professionals on Wall Street use implied volatility to potentially find big profits in the markets. Don't forget to hit that like button nearby and subscribe to our channel if you want to learn more about options trading and our favorite option trading strategies. Let's dive in. We're going to have a discussion here on implied volatility. And so many traders don't even think about implied volatility because honestly, it sounds really difficult and it sounds really confusing and it sounds too advanced. But I will tell you, as an expert in volatility, when I say expert, I mean that because I get called upon by the CBOE, by the CME, by many of the major news channels out there to talk about implied volatility and what it really means. And without truly understanding it and then being able to use it in your arsenal, okay, if you don't use it, you are really missing out. I have experienced firsthand how people can be, let's say, long some calls because they think a stock is going to go up and the stock goes up massively and they lose money. Or long puts because they think a stock is going down and the stock does go down massively and they lose money. All because of implied volatility. So it's imperative to understand implied volatility. So let's talk about this, all right? And I'm going to use the whiteboard here. What is implied volatility? Okay, basically implied volatility tells us how expensive or how cheap an option is based on history, based on its historical trend of premium. Now, we all know that the higher the volatility in anything, not just option trading, but the higher the volatility in anything, that means things are swinging around all the time, right? That means things are back and forth and back and forth. So things that are more volatile typically cost more. Things that are less volatile, when things are complacent, cost less. Same thing with options. And what we'll see is on any particular stock here, on any particular stock here, we can see a volatility chart. And I'm going to pull one up here on Apple. Okay, so if we look at this chart here, which is now just implied volatility. Okay, it looks like a stock chart, but you're going to see trends. You're going to see trends, highs and lows. Okay, highs and lows. Now, implied volatility is something that is called mean reverting. That's right, mean reverting. What that means is, mathematically, it's always going to find its average, its mid-level. So when it's really, really high, 100% of the time, it's coming down. And when it's really low, 100% of the time, it's moving up. And you can see that on this chart here. I just drew the kind of the top range, the bottom range, and you can see how volatility will find its center point. Now, the key as traders is to know how to take advantage of that. And not to make this too easy or too simplistic, but essentially, you want to sell when something's expensive and you want to buy when something is cheap. It's no different with implied volatility. Okay, so let's get back to our whiteboard here. IV, or implied volatility, always has a range. And as I said, implied volatility is mean reverting, which means it will always find its average price. The key is to know when to sell, when to buy, when to anticipate volatility going up, when to anticipate volatility going down. That's kind of just a very simplistic overview. Now, let's get into how we actually measure implied volatility. We've already spoken about delta, and we know that what delta represents is how much the price of an option moves as the stock moves $1. Well, the Greek measurement in option trading for volatility is called vega. And it's really easy to remember that because you've got vega volatility, V and V. Okay? What vega measures is how much the price of an option will move as the as the implied volatility of an option moves 1 point. Okay? So let me put that up on the whiteboard here. Vega measures the move in the price of an option as implied volatility moves 1 point. The higher the vega, the more that option is going to move. The more that option is going to be sensitive to a move in volatility. The lower the vega, the less sensitive it is to a move in volatility. Now, let's talk a couple things about vega, okay? As an option gets closer and closer to expiration, the vega decreases. So volatility becomes less important the closer and closer you get to expiration of an option. Delta really just takes over as you get towards expiration. Okay? The further out in time, the more vega impacts the price of an option. Okay? Let's take a look at how. Let's take a look at why. Okay? I'm going to go back to our Apple example here. We're going to use Apple. And we're going to look at an option that expires just out in a week. Okay? And right now, Apple is trading 175.60-ish. Okay? If we look at the money options here, which I've just circled here, I've got a column here that says vega. Tells us what that volatility sensitivity is. And you can see it's right around 10 cents. Okay, 9.8, 9.7, that means it's 10 cents. What that means is for every 1 point that the implied volatility in Apple moves, the value of that option is going to change by approximately 10 cents. If the vol goes up, the value of that option is going to go up by 10 cents. If the value of that implied volatility goes down a point, the option is going to lose 10 cents. Okay? Now, the implied volatility right now in Apple is 40. That's measured in percentage terms. That's 40%. Okay, let me put this on the whiteboard now. Okay, so we've talked about vega. Implied volatility is measured in percentage terms. Now, 40%, you may not know what that means. I don't know if that's high, that's low, that's, somewhere in the middle. Well, that's why we use our implied volatility historical chart here. Okay, so if I look right now at an implied volatility of 40% in Apple, man, that's way up here at the top of its range. If I look at this graph, if I look at this chart here, okay, that volatility is absolutely going to decrease. It is absolutely going to come down and find its middle ground. Now, the key is we don't know whether that's going to happen tomorrow, the next day, next week. We do know it will happen, but this is something that we need to learn about reading charts. But if we see that the implied volatility in Apple options are trading 40%, we can look at that and say, that's really, really expensive. The more expensive the volatility is, the more expensive options are, the more premium that options will have. Okay, now, we just looked at Apple has an implied volatility of 40%. All right, Scott, great, it's 40%. What does that really mean? What does it mean if it's 20%? What does it mean if it's 80%? Okay, what implied volatility measures is the expected move in a stock over the next year. Okay, think about that for a second. Implied volatility measures the expected move, what the market is pricing in a stock over the next year. So with Apple trading, in this example here, Apple was trading 175. The IV was 40%. If I do some simple math here and take 175 times 40, okay, I get $70. So what the market is anticipating, or what the market is pricing in right now, is that over the next year, the market is anticipating an expected range in Apple of the current price of 175 plus or minus that expected move based on the implied volatility, which is $70, or a range of 105 up to 245. Okay? Again, 40% implied volatility. That measures what the market is anticipating a move in a particular stock would be over the next year. So we can see if Apple was really cheap, Apple volatility that is, okay? If Apple implied volatility was down at the bottom of its range. What do I mean at the bottom of its range? Okay, right down here, right around, let's call it 22, 23% implied volatility. Okay, if we do the same math, we're going to see what the expected move would be. So we do the same math. 175 stock price times 0.23 now. Okay, 0.23, we get an expected move then over the next year of only $40 roughly. Okay, or a range of, again, 175 plus or minus 40-ish, we're just going to round that off right now, equals a range of 135 up to 215. So if we compare this, right, if we compare the 40% implied vol, which gives us this range right here, to the 23% implied vol, which gives us this range, we can see the wider the range, the more expensive options should be, right? Because the probability is that that stock can be all over the place. So what this tells us again, and most people don't understand what implied volatility measures. What implied volatility measures is the market's anticipation for how wide of a range a stock will trade in over the next year. The wider that expected range, the more expensive those options are going to be. The tighter that range, the less expensive options are going to be. So what does that mean for our everyday trading? What it means is we want to look for strategies to sell options when vol is really expensive or credit spreads collecting in money. And we want to look for strategies to buy options or to buy volatility when volatility is really cheap. Because we know that when it's down here, it's moving up. And when it's up here, it's moving down. Again, we don't know the exact timing of that, but we know that is going to happen. And we need to be able to use and to understand this past performance, right? Historical data of volatility ranges to predict the future. And without understanding that, your trading profits can get seriously impacted. Hopefully everybody understands that right now. I know that, volatility can be, pretty confusing, but we must understand that. The bottom line is you don't want to buy vol when it's really high. You don't want to sell it when it's really cheap. Okay, now let's see how volatility actually impacts the price of individual options here in Apple. And we're going to look at these options again here. The 175 calls are on this side, puts are on this side. Now, one other thing to understand and to know about volatility, about vega, okay, is the vega of an option is the exact same for both a call and a put at the same strike, at the same expiration. The vega of a call and a put option are the exact same at the same strike and same expiration. Okay? If calls and puts moved differently from a volatility standpoint, okay, not from a delta standpoint, but from a volatility standpoint, there would be a massive arbitrage. Okay? It just doesn't happen. I shouldn't say it doesn't happen. It does happen in the instance of some very extraneous circumstances, like if a stock is hard to borrow, as we saw some of the meme stocks earlier this year where you couldn't short a stock, then you may see the volatility of put options perhaps being greater than call options. But generally speaking, and for probably 98% of the cases, that vega number, the amount that the volatility impacts an option, is going to be the same for a call and a put. Let's go back here. And we're going to focus in on these 175 calls right now. Okay, the 175 call, again, has a vega of almost 10 cents. Again, that means that for every 1 point the implied volatility changes, the value of that option is going to change 10 cents. Okay, so let's look at this example on the screen. Right now, we can see the current price of Apple of this option, of the December 23rd 175 call option, is about $3.88. The implied volatility of that option is about 40%. The vega is almost 10. If I adjust this implied volatility by just 1 point, up or down, we should see the value of this option right here change by roughly 10 cents. So watch the middle part here. I am going to decrease the implied vol, and look at that. The volatility or the value of that option went down by about 10 cents. Now I'm going to increase this implied vol by 1 point, and you can see the value of that option went up by 10 cents. So what this tells us is we know that if we're buying expensive volatility, the likelihood is it's going to come down. And the value of the option that we just bought is going to go lower. Same thing if we sell volatility when volatility is down at the bottom end of its range and the likelihood is it's going to go up, then the option we've sold could become worth more. Now, for comparison purposes, let's focus in right now on the put side. Okay? The put side, the December 175 put, has the same implied vol, 40% ish as the call. And that put right now is trading about 407. That vega is the same, of about 10 cents. Okay? It's same, about 10 cents. So if I go in here and I change the implied volatility on that put, if I lower at 1 point, you can see that the value of that option just dropped by about 10 cents. And if I were to raise it 1 point from where it was, you can see the value of that option just increased by about 10 cents. So same thing happens to the call and the put. Okay? Very important to understand that vega is the same for both a call and a put with the same expiration at the same strike. Okay? Now, other properties of vega. We already talked about how the closer we get to expiration, the less impact vol has on an option. Okay? And that's reflected by its vega. The further out we go in time, the higher that vega, or the higher the volatility impact is going to be. So the further out in time, the more impact vega has on an option. Let's take a look at that. Okay, we were just looking at December 23rd options that had a vega of about 10 cents. Let's go out 1 month. Okay, let's go out 1 month. Look at the same exact option here, the 175, but just 1 month later, and you can see that vega has basically doubled. It's about 21, 22 cents here, which means for every 1 point that volatility changes, that impact on that option is not going to be 10 cents. It's now going to be 21, 22 cents. And if we go even further out in time, let's look at June options. Okay, same example here. Let's look at the 175. Now that vega is up almost 50 cents. Okay, so you can see the further you go out in time, the more sensitive options are to a change in implied volatility. Okay, remember that. The further you go out in time, the more sensitive an option is to a change in volatility. Now, besides just looking at length of time to look at a change in volatility, it also really matters where that option is. Is it at the money? Is it in the money? Is it out of the money? Okay, well, let's look at what's called a volatility curve. Okay, again, at the money here, meaning what option is kind of right where the stock is trading. At the money is 175. And we can see that that vega is about 10 cents. The further you go away from that strike, either up or down, so either in the money or out of the money, you can see how the vega gets less and less and less the further you go away from where the stock is trading. So the volatility impact on an option becomes less and less the further in the money or further out of the money that you go. Okay, so not only is the volatility impact or vega greater the further out in time you go, but volatility or vega has the highest impact for at the money options. The further away you go from the at the money strike, meaning where the stock is trading, so either the further in the money, further out of the money, the less impact volatility or vega will have on the price of that option. Okay, hopefully everybody understands that here, and I want to go through one more example here, and let's go back to our chart here in Apple. Okay, now when we're deciding to trade from a volatility perspective, we still need to do our analysis. We still need to do our diligence on direction, right? We still need to look at and see, are we bullish? Are we bearish? Or even are we neutral? And there are different strategies and different setups for each scenario. The key to remember for any scenario you want to be in, okay? The key is to remember that you don't want to buy expensive IV, and you don't want to sell cheap IV. Okay, so when volatility is expensive, again, regardless of direction, regardless of whether you're bullish or bearish or even neutral, okay, you would rather have a position that is either neutral or short Vega. Short meaning you have sold volatility. Because the rationale behind that is, if volatility is really expensive, we're looking at our charts, more likely than not, that volatility is going to decrease. So the options that you have sold become worth less. And when vol is cheap, you would rather have a position that is either neutral or long Vega. Long meaning you've bought options, you've bought volatility, because the likelihood is, if you're buying volatility when it's at the bottom of the range, the likelihood is it's going up. So that is kind of a beginner's introduction into implied volatility. And I can't really kind of harp on and overstate enough how important it is to understand implied volatility with your trading strategies. In my world, and doing this for over 30 years, okay, my holy grail, if you will, okay, is when I can look at analysis, technical charts, fundamental, whatever it is, have a good idea of direction, okay, up, down, or neutral of a stock, but then be able to combine that with an option strategy that gets me to whatever volatility position I want to have, long, short, or even neutral. And the combination of those two, in my experience, doing this for 30 years and being a volatility expert, that is how you can really, really jumpstart your profits and maximize those profits. All right, guys, that's a wrap up of an intro into implied volatility. Really appreciate you joining me. Please remember to like, comment, and subscribe, and we'll see you on the next one.